Gold is currently at record highs, trading above $4,300 per ounce in December 2025. But could this rally reverse? Today, we're reanalyzing 5 critical factors in the American economy that could push gold prices down in the coming months. Reason 1. Strengthening US dollar inverse relationship between dollar and gold. Statistically, gold is priced in US dollars globally. When the dollar strengthens by 10%, gold typically falls 15 to 20%. The US dollar index DXY remains a critical predictor. Visual suggestion. Chart showing inverse correlation between DXY and gold prices, the first major threat to gold. A strengthening US dollar. Here's why this matters. Gold is priced in dollars worldwide. When the dollar gains strength, it takes fewer dollars to buy the same amount of gold, making it more expensive for international buyers. This reduces global demand and pushes prices down. According to market analysis, a 10% increase in dollar strength historically correlates with a 15 to 20% decline in gold prices. If the Trump administration's business-friendly policies accelerate U.S. economic growth beyond expectations, the dollar could rally significantly in 2026. Reason 2. Rising interest rates and Fed policy. Higher rates make gold less attractive statistically. Fed delivered 325 basis point rate cuts in 2025. Some Fed officials suggest rates may stay higher in 2026. Gold is a non-yielding asset. It pays no dividends or interest. Visual suggestion. Federal Reserve Building. Interest rate charts. Reason number 2. Rising interest rates. In December 2025, the Federal Reserve delivered its third rate cut, but 3 policymakers dissented, stating that inflation remains too elevated. Here's the problem for gold investors. Gold generates no yield. When interest rates rise, investors can earn 4 to 5% returns on treasury bonds or savings accounts without any risk. This makes holding gold, which pays nothing, much less attractive. If the Fed pauses rate cuts or even raises rates in 2026 to combat persistent inflation, gold could face significant selling pressure. Reason 3. Accelerating U.S. economic growth. Strong growth reduces safe haven demand. Statistically, U.S. GDP. Growth stronger than expected in 2025. Manufacturing sector showing resilience. Bear case scenario. Gold could fall to $2,200, $2,600 per ounce. Visual suggestion. Factory footage. Economic growth graphs. The third factor is accelerating U.S. economic growth. State Street Global Advisors outlined a bear case scenario where gold trades between $2,200 and $2,600 per ounce if the new administration's business-friendly policies strengthen manufacturing far beyond expectations. Strong economic growth reduces uncertainty and fear in markets. When businesses are thriving and unemployment is low, investors do not need the safety of gold. They prefer stocks and corporate bonds that offer higher returns. A booming U.S. economy in 2026 could trigger massive outflows from gold investments. Reason 4. Reduced inflation. Concerns lower inflation weakens gold's hedge. Appeal statistically, gold is traditionally viewed as an inflation hedge. If inflation returns to Fed's 2% target, demand for gold decreases. Real interest rates minus inflation are critical visual suggestion. Inflation charts. Grocery store footage. Reason 4. Declining inflation pressures. Gold has historically been viewed as a hedge against inflation, a way to protect purchasing power when prices rise. But what happens when inflation falls? If the Fed successfully brings inflation back to its 2% target without triggering a recession, the primary reason many investors buy gold disappears. Moreover, falling inflation combined with stable or rising interest rates increases real yields, the actual return after accounting for inflation. Higher real yields are gold's kryptonite, making bonds and cash far more attractive than holding non-yielding gold bars. Reason 5. Profit-taking and demand destruction. High prices reduce physical demand. Statistically, gold up 60% year-to-date. In 2025, jewelry demand showing weakness worst. Q2 since Q3 2020, jewelry accounts for 40% of total gold consumption. Central banks may purchase less gold to meet reserve targets at higher prices. Visual suggestion. Jewelry stores, ETF trading screens. The final reason is something economists called demand destruction. Gold has rallied an incredible 60% in 2025, and Morgan Stanley analysts warn that these high prices are already causing problems. Jewelry demand hit its weakest level since 2020 as consumers resist paying premium prices. This is critical because jewelry accounts for 40% of all gold consumption. Additionally, after such massive gains, investors may simply take profits and rotate into other assets. Even central banks, which have been huge buyers, may reduce purchases since they need to buy less gold at $4,300 per ounce to achieve their reserve targets compared to lower prices. Conclusion of my video. So there you have it. 5 powerful factors that could reverse gold's historic rally. It's a strengthening dollar, rising interest rates, accelerating US growth, falling inflation, and demand destruction from high prices. While gold currently enjoys strong support from geopolitical uncertainty and central bank buying, these economic forces from America could shift sentiment dramatically. Remember, markets are unpredictable, and smart investors always consider both bullish and bearish scenarios. What's your prediction for gold in 2026? Comment below. So there you have it. 5 powerful factors that could reverse gold's historic rally. A strengthening dollar, rising interest rates, accelerating US growth, falling inflation, and demand destruction from high prices. While gold currently enjoys strong support from geopolitical uncertainty and central bank buying, these economic forces from America could shift sentiment dramatically. Remember, markets are unpredictable, and smart investors always consider both bullish and bearish scenarios. What's your prediction for gold in 2026? Comment below. So there you have it, 5 powerful factors that could reverse gold's historic rally. A strengthening dollar, rising interest rates, accelerating US growth, falling inflation, and demand destruction from high prices. While gold currently enjoys strong support from geopolitical uncertainty and central bank buying, these economic forces from America could shift sentiment dramatically. Remember, markets are unpredictable, and smart investors always consider both bullish and bearish scenarios. What's your prediction for gold in 2026? Comment below.